welcome out, guys. It is our feature presentation from Trading Justice podcast. And I got to look up the episode number, Tyler. I think it's like 333. And I was trying to think how many podcasts you've been on. First of all, welcome out, my friend.
Good to see you, Timmy.
Yeah.
Probably 300 of them. I mean, around there.
It might feel like that sometimes, but I think it might be like 4 or 5, maybe 6, 7, 8.
Just a handful. Yeah. Glad to be here, though.
Always good to have you. You know, I wanted to bring you on and just kind of talk to you. Obviously, whenever we do a podcast, we bring on different guests for different reasons, but you're a contributor, you're a coach, you're a member of our community, you're a colleague and a friend of mine, and you've been a part of teaching people how to trade now that I've been a part of for like 10, 12 years. So I do want to talk about markets right now. I got to get right down to business and get right to the heat of it. Markets are selling pretty hard right now. Tyler, what are you doing in your own personal trading to handle it?
I'm under my desk in the fetal position. You just got me to crawl out for this little interview here, Tim.
Yeah. Do you cry yourself to sleep at night as well?
You know what? Actually, in all seriousness, this is a day where you thank your lucky stars for diversification, for proper risk protocols, and for having a game plan ahead of time.
But that's preparation. Yeah. I mean, it's not lucky stars when you were the one who diversified it. You had a game plan and you had hedges in place, right?
Yeah, I mean, look, if you're leaning bullish into a day like today, you're going to lose money. Nobody makes money on a day like today if you had a bullish portfolio, unless you did some insanely expert hedging or something. And in that case, I'd say you got semi-lucky. So this is part of the game, right? You take hits like this every once in a while, and the whole goal is to size correctly so you can live through it. This will pass. We've seen this before. We'll see it again. But yeah, it all goes back to risk management, Tim, and preparing ahead of time, because you don't want to be asking yourself right now, what am I supposed to do now? Mm-hmm. You should ask yourself that before the market gets punched in the face like this.
Yeah. And by the way, if you don't know this, Tyler's a mentor for Legacy Education. He's been a trader since 2006, and you're actually the architect of a system we call the Bear Market Survival Guide. And so, you know, you've studied this stuff, and so have I, and we've looked at it. We've also been around markets now 14 years. Is this happening more frequently than it did, you know, through the course of history? Because you've gone back and looked at market cycles when they were bullish and bearish in the 20s, 30s, 40s, 50s. You studied the time of it. You put a lot of time into the analytics behind it. Is it different now than it was then, or do we just assume things are different because we're in the thick of it?
Well, I think, and I'd love to see data to the contrary. Based on what I've seen, I don't think it's any different. Obviously, you have different dynamics with algorithmic trading and everything. But you look at 1987, I mean, they didn't have a ton of algorithms back then, right? You look at 1929, they didn't have a ton of computers back then. So fear and panic has always been a part of the market. Does it happen faster? I mean, maybe, but you look at some of the crashes historically, and I don't know. I don't know that it matters either. Like, I don't know that you would change your techniques in terms of how you would protect yourself. So I don't spend a lot of time wondering, is it different? Are the crashes a little bit quicker? I think the takeaway is we have crashes, we have volatility, we have bear markets. What are you going to do about it?
Yeah. Yeah, we do. And you're always going to have bear markets. I think one of the key takeaways from bear markets is that eventually they do end and they come back up.
Yep.
Now, when you're at the start of it, at the top, I mean, that's not exactly a reason to just put your head in the sand and ignore the price action today. You have to do something with the information in front of you. And we're only about 5-6% off the very top of the market. What advice do you give beginners out there when they're looking at this risk popping in? Like you said, we're down 4% today on the day we're talking. So,
yeah, I mean, I would say if this is your first time paying attention, welcome to the markets, first of all. It seems like market is benign and quiet and slow for long enough to make you forget that sometimes, oh, wait, it does go down. We do have craziness. So the first thing is, if you didn't have a plan going into today, who cares? Let's have a plan for next time. And so let's prepare ourselves. Let's learn how to hedge. Let's learn how to protect. Let's learn proper risk protocols so that next time, you know what to do and you have a plan ahead of time. I mean, if nothing else, Tim, what happens? If you're an active trader, you get stopped out of trades. You lose the amount you expected to lose, maybe a little more because we gap lower, and you move on with your life. It's those that don't have an exit plan, and that it gets more painful and more painful and more painful. And then you hit your pain threshold, you give up, and the market bounces without you. I mean, it happens again and again.
Yeah, I agree. And the way that you approach stop losses and trading plans, if you're a trader, that's different than if you're an investor, right? And I think one of the very first things I have to do whenever I'm mentoring somebody, Tyler, is get them to separate the mindset of investing and trading, because both are valuable, both are important to learn how to do it. But your longer term assets that you're trying to build into wealth or your retirement, you shouldn't have a stop loss 5 cents below the intraday low or something like that.
Of course, yeah, of course.
Different way to approach it, right?
Yeah.
So from a philosophical perspective, how do you teach trading versus investing? What are the differences between the two?
Well, part of it's time frame. When it comes to investing, you have a much longer time frame, and you have to have a different risk management rules, right? So you think about the classic approach is you diversify, right? So I got a guy mentoring right now, and he has a long-term retirement account. We say, well, what's the traditional metric? The traditional metric is, in terms of preparing for a bear market, is look, you don't put all your money in stocks unless you're willing to stomach a pretty big drawdown, 30% on average, typical bear market. And if you're not willing to do that, you got to diversify into things like gold and bonds and whatever. So you have proper asset allocation. But even then, if you say, well, is there something else I can do? Sure. Go look at the bear market survival guide. We talk about buying put options to protect. So a day like today, Tim, insurance, most of the time you feel like it's a drag on your portfolio. If you've been owning puts for the last few months, it's like, why do I own this protection? Well, today is why you own it, right? Your portfolio is getting smoked and your puts are up, reducing your loss by 30, 40, 50%. So you could use puts to protect. I think
it's a tough thing emotionally and mindset wise though. And I think it's important that you got to reiterate this point, because if you stick money into insurance and you're new at it, you might logically understand why you're hedging, right? I was trained on this, or my mentor told me to do it, or I understand the reason to bring my numbers down. But when you're watching the insurance losing and you're like, well, man, why do I own that insurance? The market's at the all-time high. You kind of don't have the context until you go through something like this, right?
Yeah. And there's nothing better, Tim, than looking at the account and saying, okay, my stocks are down this much. My insurance is up this much. It's reduced the volatility. It's reduced the pain. It's made it easier for me to live through this and not want to panic and puke up my stocks. The hardest part of being a long-term investor is you have to experience this volatility. So any tactic where you can reduce the volatility and reduce the emotions connected to it is a valuable tactic. And you do have to see it a couple of times. You got to get in there, buy the put, see what happens in normal markets versus a crash. And I think, Tim, once you go through that cycle once or twice, then it's embedded in your brain and you have a much better idea of how to manage it.
I agree. I was down in Orlando about, it's got to be over a year ago now. And I actually had one of our students come out and see me. He took a class from you. His name's Jason. Jason, if you're listening, you know who you are. And he told a story about his dad, that I'll never forget. And it reminded me this exact thing right here. He said, I call my dad, and my dad is old school. He's just a buy and hold, leave it, don't touch it kind of guy. I said, Dad, you got to buy leap put options, right? And this was in the middle of 2018. And so his dad, trusting his son, he's like, all right, I'll do that just because I understand you've been doing this for a couple of years. You know what you're doing. I'll trust you. I'll follow your lead on this. And they delta hedged the longer term portfolio. And his dad kept calling him like every week, Jason, these are down. I'm losing money on them, losing until boom, October, and the market went straight down.
Yeah.
And his dad starts calling him every day. Jason, what do I do? Now they're making me money. What do I do now? How do I understand that? It's a new mindset for most people. Just the idea that you can have a product that you can invest in that will offset some of the losses when these things happen. For most people out there, Tyler, they are never introduced into that like Jason's dad. How do we bridge that? How do we, as Tackle Trading, the podcast here, mentors, how do we get the public to understand that options are there to remove risk, not to add risk?
Well, you get on a bully pulpit, Tim, and you hit the table and you tell them. I think that's the first thing. You got to introduce them to the concept, right? And buy into the idea. But sometimes it's Pandora's box, though, Tim. You introduce somebody to the idea and they go do it. And then they get in that position where they're making money on the put and they really don't know what to do. It's like, well, I get it. I'm invested. Now, how do I manage this? it's a bigger conversation than just accepting the idea. And,
Yeah.
and isn't that why we created something like the Bear Market Survival Guide, where we walk you step by step through how to manage the thing? So
There's
that's
no
why we have
doubt.
products like that, to make it easy and just follow along. And first you buy in, then you go and you participate in trainings and things that we have so you can get all the little details.
I got a question for you. I got several different topics I want to hit on before we're done here. Number one, is this cycle different than other cycles? Okay. Traditional business cycle, interest rates go up and down, and it affects the way people invest into either different types of assets, right? And right now we have lowering interest rates on the Fed, but you're at the top end of a bull market. Are there other circumstances where you've seen something similar in your studies of the history?
Well, the analog that I've seen people point to is the 90s. I think like 95, they cut rates once. So one of the reasons why the market threw a temper tantrum is they want the beginning of multiple rate cuts. And then maybe you guys have talked about this. So Jerome Powell says, no, we're looking at this as a mid-cycle adjustment, which basically means, I mean, do you think we're in the middle of a cycle? I mean, what is this going to be, like a 25-year? Maybe, but if they cut rates and they're viewing this as the economy is going to continue expanding, maybe later we'll need to raise rates. I guess, hopefully, Tim, right? I mean, sure, if the economy keeps humming along and you can support that. But anyways, my point is the 90s, I believe they cut rates like 95, 94 once, maybe twice, and the economy continued to expand, and later they had to raise rates again. So I think there is some historical precedence. As to whether it's different this time, the phrase that I like is it's different every time, right? You have recurring themes, but every kind of cycle is a little bit unique in terms of the dynamics. And that's what makes it hard, is you can study prior cycles and know like typically how it played out, but every time it's a little bit hard to apply it real time and know, timing wise, is this going to be the beginning of a big easing cycle? Will we be a year from now and the economy is back on track and they're hiking rates again? It would be easier, Tim, if this was it, right? And it's like, okay, they've rung the bell. They're done raising rates. They're now lowering rates. We're going to get 5, 6 rate cuts. We're going to get a recession. We're going to get a reset, a big bear market. And then we start the game again. Yeah, sure. Follow that script. But the problem is it's messy sometimes.
Yeah. Yeah, it is very, very messy. And by the way, a full on bear market is 25% or more, correct?
Technically 20%.
20% or more.
Mm-hmm.
So we had a bear market in October through December of 2018. That did have a bear market with no recession.
Mm-hmm.
We had precipitous selling in February of 2018 with the trade war. And then we also had selling here this May. And now, a little bit now that we're starting from the top, but we don't know where this is going to end. But we're down 4% on a day here. Obviously, there's risk going on right now.
Yeah.
When you're studying some of these differences, do you notice anything in the difference between those 10% sell-offs and the ones that escalate into the 20, 30, 40, 50? Was there some other catalyst outside of the news? What have you seen studying the history of it?
I've seen it's friggin' hard, dude. I wish they told you like which 5% drop was going to become a 30% crash, and which one was just a garden variety pullback or retracement, and then we go right back up. I think this is where, what's the phrase? It's like the more you learn about something, the stupider you feel, right? Because you become more aware as to the actual difficulty of a topic.
Yeah.
So the phrase I like is the foolish man thinks he is wise, but the wise man knows himself to be a fool, right? So I think sometimes the more you study something, the closer and closer you get just to the realization that like, I really don't know anything, right?
Well, there's a lot of randomness in the market. You're right. I mean, the difference between, and this is, I guess, where I'm going with it as well. I love where you're heading. I've studied this and watched these 10% sell-offs just go straight back up.
Yeah.
And I've also seen these 5-10% sell-offs spin into something very precipitous, like the 2008 crash, some of the volatility we saw in August of 2012 and other areas where it just starts going straight down as well. The difference between the two, I don't think any real person knows if one is going to happen or the other when you start into this tailspin, right?
I agree.
Which is where asset allocation, position sizing, diversification, holdings into different kinds of products, and just hedging the dang thing is the appropriate approach if you're a veteran and trained trader, because we don't know the future. I mean, Tyler, next month the market could be at an all-time high, and we're talking about the Fed cutting again because they capitulated to this stuff and markets got their wish, right? Or next
Yeah,
month we could be talking about
100%.
continued selling.
So you have to have, I think you have to be satisfied with knowing that you don't really know which one's going to be the big one, and just coming up with a plan as to how to deal with it, recognizing sometimes, you know, you're going to protect and you're going to be like the gentleman you talked about, where you feel like, why do I own protection? Why am I diversified? But it always comes back to being a smart idea when things like this happen, where you think you're lucky stars, you're not 100% in stocks unprotected. So I don't think there is a right answer. I think the key is to find a path that allows you to invest in the markets comfortably, having a plan for the crazy volatility that it comes. Because if your success is dependent on you predicting which 5% drop is going to become a major bear market, I don't think you'll be successful.
And that gets back to the old investor versus trader discussion, right? The mindset of an investor, if you know what you're doing, you understand the cycles, you're willing to take on that risk and then hedge it through diversification, allocation, and hedging. And it's just part of it, you know, you kind of just work through it. In fact, I've said this to people before, and if you ask me what product I'm going to invest in, I'm still going to invest in the stock market, you know, even with the risk, even with the crashing potential, and even with all the volatility. And I'll tell you why. What else are you going to get the returns out of? Maybe gold, but I invest in gold as well. Maybe some of the other assets, sure, real estate, property, you name it. But am I going to put my money in savings and get 2%, you know, a year? When inflation's at 2.5%, 3%, and that's if we believe what those numbers are. Am I going to put it into bonds where those rates are coming down, those yields are coming down? There are some equities that pay good dividends that might be nice, but even with the market volatility and risk, as an investor, Tyler, not as a trader, because as a trader you do it different, I still see stocks as an attractive asset to accumulate over the long haul. You know, how do you bridge 100%. That?
Well, and I had a conversation with a student the other day, and he had talked about, there's a lot of people that are doom and gloomers, and they talk about, I think Jim Rickards was one of the books he was talking about. And the problem I have sometimes with people who poo-poo different asset classes is it's like, wait a second. So stocks suck, bonds suck, real estate's going down, don't put your money in the dollar. It's like, so pretty much you're saying what? Like, where am I supposed to put my money? Money's got to go somewhere, right? I have capital. I want some type of return. I'm not the only person. There are millions of people like that. So I think it's a very hard argument to make to just bash every single asset class, because they all have trade-offs. They all have pros and cons. And very smart people, very wealthy people invest in the stock market and have invested in the stock market for decades and decades and decades. Mm-hmm. And so it's like, what do you do then? I mean, you got money, you got to put it somewhere.
Correct. And I think actually what you're talking about in terms of the progression of understanding that you don't know everything, at some point you get over that learning curve, that intimidation of, oh my God, I don't know the future. I don't know everything. Look at how much information is out there. You then get to the confidence to realize that's okay, right, and you can still invest with confidence because you know the data. I'm a numbers guy, Tyler, and I got to tell you, knowing how bear markets reacted, you know, what my expected returns are, what the month-by-month volatility in the stock market is. These are all things, these are all data points that help my brain. Because then when it's happening in front of you, it doesn't shock the system, you know? And as a veteran, it's easy to say that, but if you're out there and you're new, one of the best recommendations I would give you is to study the history of price action, you know, have conversations with mentors like Tyler so you realize, yeah, you can invest in stocks and take a 30% hit. If you're not prepared for that mentally, you haven't studied the history, right, Tyler?
Well, and that was one of the goals of the Bear Market Survival Guide, is to give you all the context, right? Because you're right. The market will surprise you and surprise you and surprise you, but it should get to the point where it doesn't surprise you anymore, right? Mm-hmm. We're like, dude, I've seen this movie before. And if nothing else, getting comfortable with the context and what's typical, it does prevent you from panicking, right? You think about your behavior on a day like today. If this was the very first time you see the stock market sell off 4% in one day, you're like freaking out. Yeah. If it's like, I've seen this before, like I know how this movie plays out. I know the plot twists. Maybe this one's a little different, but when you know the ending before you sit down or start watching the movie, it's not as exciting, and surprising, which is a good thing when you're talking about real money.
Mm-hmm.
So, and the thing is with the bear market survival guide, like I would love at the end to say, okay, you look at this, and this, and then you know exactly what's going to happen, right?
Yeah.
But the interesting thing is we do these monthly mastermind group meetings, and the objective, so this is for those that have the system, we meet once a month to talk about current market conditions. And it's interesting because we lay out themes or signals that we've seen historically that maybe signal we're at the late stage of the economic expansion. When you start to look at this real time, month to month, you actually start to more fully appreciate the difficulty and the challenge of trying to time it.
Yeah.
Right? Where it's like historically you see 1, 2, and 3, and it doesn't bode well. But what does that mean for next week? I'm not sure. Like I wish I knew. But it gives us better contextual awareness as to where we may be. We're better able to anticipate potential scenarios. And so I think, like you said, context is really the biggest advantage to studying that history.
Well, and here's one of the most beautiful things about hedging, if you know how to do it, is when you start seeing risks 1, risk 2, risk 3, maybe you add a little bit different hedge, right?
Sure.
You add a couple of leap put options on the SPY relative to your beta weight, and you bring that delta down just a little bit. Now, if you don't know those terms, you got to learn those terms, right? Understanding what your risk is relative to your insurance position, or maybe if you're brand new, just realizing you can get insurance in the first place is pretty powerful. And when you see certain risks pop up, Tyler, maybe you back off the delta a little bit. Sure. And find a balance that you're comfortable with confidence, because that's all investing really is. You know?
Well, and then you know what to do, right? It's like, so if you see this, and this, most people, they're like, well, I saw that and I have no idea what to do, right? So I'm just going to go hide in my bunker. Well, the whole idea of the education is if you see these things, if you want to reduce risk, here's how, right? Here's how you can quantify how much exposure you have. Here's how you can reduce that risk. And then come what may, you at least have defined how much you're going to lose.
You know, we've been talking to Tyler Craig here, and Tyler is a blogger. He's a coach. He did the option report last weekend. Great report, Tyler. Make sure you go check that out if you're a pro member. But one of my favorite things that you do are those blogs you do, Tyler, the Tales of a Technician and the Options Theory blog. Here in the month of August on Options Theory, you're going to be blogging about the concept of theta, you know, and how you can measure theta, how you can use theta. Out of all the stuff you do, what's your favorite thing that you do? Is it the webinars? Is it the blogging, the writing, the reports, the mentorship, the coaching?
I think it changes. It depends. I mean, every mentor student I've ever had is just top notch. But sometimes, you know, you get some and it's like, this is probably not my favorite use of time right now. Mm-hmm. I think anything that causes me to become more creative, we tend to do, it's like any worker, right? Any type of job where you do the same thing again and again and again. Sometimes it's hard to get the same satisfaction. I really like being creative. And on the blogging side, I probably get the most opportunity there. Coming up with new ways of explaining things, coming up with new analogies.
I know you well, though. If that's all you could do, you'd be screaming, "Get me back into a webinar."
I would.
Right? You know,
I like the variation, like anybody.
All the variation, yeah. I'm with you.
But I do think webinars, you get a lot of people on a webinar that are asking good questions. You know, it challenges your ability to come up with great answers and stuff. I think webinars are fun. You know,
you missed the right answer, by the way. The answer was
chatting with you on the podcast.
That's right. Oh, my favorite thing to do is to be on here with you, Tim. Right? You should have. Yeah, that was a softball. I just threw it to you.
I'm not on my A game today, but I was slow on the uptake, but I eventually got there.
No, that's the way it is. Tyler, great job today. Appreciate your insight. And guys, go and check out Tyler's content on tackletrading.com. And if you are a member of that Bear Market Survival Guide, the one thing I'll tell you, go back and revisit it. You know, even if you watched it last year, maybe it's a good refresher course to go back and check out, and make sure you're attending the mastermind groups each and every month that Tyler does. Good job, kid. We'll be back right after this live read from Coach Mark.